You've been driving to client meetings, job sites, and business errands for years, and I just calculated that the average business owner who isn't tracking their mileage properly is losing $4,800 every single year because they don't understand the three legal methods the IRS gives you to write off your car. And one of these methods could put an extra $8,000 back in your pocket this year alone. And here's the part that's going to make you angry. You can't go back and claim mileage from last year if you didn't track it. The IRS doesn't accept estimates or your best guess. If you didn't document it, it didn't happen. But starting today, that changes because I'm going to show you the exact system I use with my clients to legally write off their vehicles and save thousands. First, let's get crystal clear on what qualifies as business mileage because this is where most people screw up. Business mileage is driving from your office to meet a client, going from one business location to another, traveling to a conference, seminar, or networking event, driving to the bank for business deposits, going to the store to buy business supplies, meeting your accountant or lawyer for business matters. Business mileage is not your commute from home to your regular office. This is personal, always. Running personal errands, even if you squeeze in one business stop. Driving your kids to school on the way to a client meeting. Here's the key. If your home office is your principal place of business and you've properly established it with the IRS, then trips from your home office to clients or other business locations are deductible. This is huge, and most people don't know this. Method 1, the standard mileage rate. This is the simplest method and the one most people should use. For 2024, the IRS gives you 60 cents per mile. For 2025, it's 70 cents per mile. So every business mile you drive, you get to deduct that amount from your taxable income. Let's do the math. If you drive 10,000 business miles in a year at 70 cents per mile, that's a $7,000 deduction. If you're in the 24% tax bracket, that's $1,680 back in your pocket. If you drive 20,000 business miles, that's a $14,000 deduction, saving you $3,360 in taxes. Here's what the standard mileage rate covers: gas, oil changes, repairs, tires, insurance, registration, depreciation, everything. You don't track individual expenses, you just track miles. That's it. But there's a catch. You have to choose this method in the first year you use the car for business. If you use the actual expense method in year 1, you're locked out of standard mileage for that vehicle forever. What you can still deduct on top of standard mileage: parking fees for business, tolls for business trips, car loan interest, the business use percentage. What you cannot deduct: gas receipts, it's already in the 70 cents, oil changes, already included, car washes, already included. Most small business owners and self-employed people should use this method. It's simple, it's clean, and the IRS rate is actually pretty generous.
Method 2, the actual expense method. This is where you track every single expense related to your car and deduct the business use percentage. Expenses you can track: gas, oil changes, repairs and maintenance, tires, insurance, registration and licensing, car loan interest, lease payments, depreciation or Section 179 expense, car washes, AAA membership. Here's how it works. Let's say you drive 30,000 miles total in a year, and 20,000 of those are business miles. That's 67% business use. If your total car expenses for the year are $12,000, you multiply that by 67% and you get an $8,040 deduction. When does this method make sense? Expensive vehicles. If you bought a $70,000 luxury SUV and you use it 80% for business, the depreciation alone could give you a massive deduction in year 1 through Section 179 or bonus depreciation. We're talking $50,000 plus in deductions. High expense vehicles. If you have an older car with expensive repairs, or you drive a truck that gets 12 mpg and you're filling up constantly, actual expenses might beat standard mileage. Leased vehicles. Lease payments are fully deductible at your business use percentage, and sometimes this beats standard mileage for expensive leases. The downsides: you have to track everything. You need receipts for everything. You have to calculate depreciation or hire someone to do it. It's more audit risk because there's more to question. Once you use actual expenses in year 1, you're locked in, though you can switch to standard mileage later with some limitations. Important note: you can't just pick the better method each year. The IRS has rules about when you can switch between methods. Method 3, the company car. This is when your business actually owns or leases the vehicle, not you personally. How it works: your LLC, S-Corp, or corporation purchases or leases the vehicle. The business pays for 100% of the expenses, and they're 100% deductible to the business, assuming 100% business use. The business owns the title, the business pays the insurance, the business pays for gas, maintenance, everything. The vehicle is listed as a business asset. But here's the catch. If you use that company car for personal use, you have to report that personal use as taxable income to you. The IRS considers personal use of a company car as compensation. When does this make sense? High-revenue businesses. If your business is making $500,000 a year, having the company-owned vehicles can make sense for liability protection and cleaner bookkeeping. Multiple employees. If you have employees who need vehicles, company cars with clear personal use policies can work well. 100% business use. If you have a work truck, cargo van, or vehicle that genuinely never gets used personally, company ownership is clean and simple. The personal use problem. If you drive the company car to dinner, to the gym, on vacation, that's personal use. The IRS has complex formulas to calculate the value of that personal use, and it gets reported as W-2 income if you're an employee of your company. Most small business owners are better off owning the vehicle personally and using Method 1 or Method 2. It's simpler and cleaner.
Here's the system that actually works. Option 1, mileage tracking apps. Recommended. Mile IQ, my favorite, automatic tracking. Everlance, QuickBooks Self-Employed, Stride. These apps use your phone's GPS to automatically track every trip. At the end of each trip, you swipe left for personal, right for business. Takes 2 seconds. At the end of the year, you have a complete IRS-compliant mileage log. Cost, $5 to $10 a month. ROI, literally thousands of dollars. Option 2, manual mileage log. Date, starting location, ending location, business purpose, miles driven. Keep this in a notebook in your car or in a spreadsheet. Update it weekly at minimum. Option 3, reconstruct from calendar. Not recommended. If you miss tracking for part of the year, you can use your calendar to reconstruct trips. March 15th, met with John Smith at his office, 45 miles round trip. The IRS allows this, but they prefer contemporaneous records, tracking as you go. What the IRS wants to see: dates, destinations, business purposes, miles. They don't need receipts for mileage, but they want a credible log. A detailed, consistent log beats a vague, "I drove about 15,000 business miles." Common mistakes to avoid. Mistake number 1, claiming 100% business use when you only have one car. If you own one vehicle and claim 100% business use, the IRS knows you're lying. How did you get groceries? How did you drive your kids to school? Be honest about your business percentage. Mistake number 2, not tracking until tax time. You can't go back and recreate a year of mileage from memory. Start tracking today. Mistake number 3, deducting commuting. Your drive from home to your regular office is commuting, not business mileage, even if you're self-employed. The only exception is if your home office is your principal place of business. Mistake number 4, mixing methods incorrectly. If you use standard mileage, you can't also deduct gas. It's one or the other. Mistake number 5, not keeping records. The IRS can audit you up to 3 years back, 6 years in some cases. Keep your mileage logs. Keep them organized. Keep them backed up. Mistake number 6, luxury car depreciation limits. The IRS caps depreciation on luxury vehicles. If you buy a $100,000 car hoping to write it all off in year 1, there are limits. Talk to your CPA about Section 179 limits and luxury auto depreciation caps. Advanced strategies. Strategy number 1, the home office advantage. If you establish a home office as your principal place of business, every trip from your home to clients, suppliers, or other business locations becomes deductible. Your home office becomes your main office, so these trips aren't commuting anymore. Strategy number 2, multiple vehicles. If you have multiple vehicles, you can use different methods for each: standard mileage for your sedan, actual expenses for your work truck. Strategy number 3, spouse's vehicle. If your spouse uses their car for your business, those miles are deductible too. Track them separately. Strategy number 4, Section 179 for heavy vehicles. Vehicles over 6,000 pounds, mini SUVs and trucks, qualify for special depreciation rules. You can potentially write off $28,900 plus in year 1. This is why you see so many business owners driving Suburbans, Yukons, and F-150s.
So, here's your action plan. This week, download a mileage tracking app today. I recommend Mile IQ. Set it up and let it track automatically. At the end of each day, spend 30 seconds categorizing trips. This month, calculate your estimated business miles for the year. Decide if standard mileage or actual expense makes more sense. For most people, it's standard mileage. If you haven't been tracking, start reconstructing from your calendar for this year. This quarter, review your year-to-date business mileage. Calculate your projected deduction. Adjust your estimated tax payments if needed. Before December 31st, if you're considering buying a business vehicle, run the numbers on Section 179. Make sure you've categorized all your trips. Export your mileage log and save it with your tax documents. Look, the average business owner drives 12,000 business miles a year. At 70 cents per mile, that's an $8,400 deduction. If you're in the 24% tax bracket, that's over $2,000 in tax savings you're leaving on the table if you're not tracking. I've created a free vehicle deduction calculator and mileage log template that does all the math for you. It compares standard mileage versus actual expenses and tells you which method saves you more. The link is in the description below. Download it today, plug in your numbers, and see how much you've been missing. And if this video just saved you thousands of dollars, do me a favor. Share it with one business owner who's still not tracking their mileage. Let's stop leaving money on the table. The IRS has given you 3 legal ways to write off your car. Now you know how to use them. Download the calculator, start tracking today, and I'll see you in the next one.